Well, greetings and welcome to Investment Strategy Brief, June 2026. So we're just off after a few days of an agreement, basically, a possible Middle East peace. So what we want to do is talk about that and sort of unpack it a little bit, but also look at it through the lens of the implications that that has and some other things have on our outlook for the second half of this year of 2026. So let's jump into it. Now, we know that the world has been defined in a lot of ways by a variety of geopolitical tensions and activities. We've stood up a dashboard for many years identifying things that are happening or risks that might happen to sort of help us understand what's happening in the world geopolitically. And a few years ago, as I've talked about before, we had to break out military conflicts in its own section because there's so many potential hotspots. And of course, the Middle East war concept was front and center. So when we had this attack on Iran, and then really almost for 4 months now, this exchange, just that thankfully we're in a bit of a peace phase at this point, sort of that risk really showed itself. And so anyway, as we look at what actually happened, we did structure an article that walked through 4 different scenarios, from regime change to a severe tail that it would go on for a very long time, or a shadow war where they say it's over, but it's not. And then the concept where we had put a 0.5% or 50% probability of a managed off-ramp. And so that's where we think we are. We're in this, it's more than a few weeks, but coming on almost 4 months. And so parties are negotiating. And specifically what we have is a peace agreement being developed. There's this interim agreement. And the idea is that there'll be 60 days to negotiate things, including sort of what's going on with the nuclear program. Of course, what the U.S. wants right out of the gate is for Iran, or for the Strait of Hormuz to open, so Iran to back off a little bit, and in exchange will allow for oil exports to start and some waivers on sanctions and access to some of their funds. And so that's all unfolding. It seems to be going well, but we have to be mindful of the risks. What can derail this? Now, the most notable probably is the idea that Israel and others continue with conflict. So even after all this was announced, there's been exchange of fire between Israel and Hezbollah, and it puts the whole thing at risk. Also, I'd say the idea that there are mines in the strait means that has to be demined. That's going to take time. And then, interestingly, as we head into really the midterm elections, the idea of political opposition to one thing or another and sort of a stirring of that will kind of play a part, I'm sure. So anyway, we're headed along in that direction. And the good news is the markets have reacted favorably, and there's sort of signals of potential success. Most notably, I think, is the oil futures forward curve. So when we plotted this kind of at the peak of trouble, the idea of, in this case, WTI, the crude getting back to around $70, that was pushed way out to 2029. And now that this has unfolded, that sort of back to normalcy forecast has moved right now as early as of about March 2027, so 9 months from now, which is pretty good. And so the market, again, is signaling that things seem to be calming down. We've seen oil prices fall. We've seen essentially in the U.S. equity markets a little flattish to down, but non-U.S. markets up a little bit. And here on page 9, probably a very important data point to look at is the one-year break-even, which peaked at 5.3% back at the end of March when all this was really heated up. But the punchline is that settled back down to the number 2%, which of course is the Fed's 2% target. So again, markets are reacting with some optimism around all this. Now, we had talked about the idea that a lot of this disruption would take time to make its way through the system. So we published an article about that. That includes sort of the increase in costs, as those increase in energy costs and other related things make their way through sort of the production of goods and services. Now, the reality is that same thing is true in reverse. So another way to say it is it's going to take some time for things to get back online. It's going to take some time for oil and other products to go through the strait to start flowing, and it'll take some time for that effect to make its way through supply chains and ultimately goods and services and the economy. Now, when it comes to interest rates, people might have thought, hey, if inflation expectations are falling, shouldn't interest rates fall? And so at first they did a little bit, then they moved back up, and they're moving around a little bit. But the punchline is they haven't come down a lot, and we really attribute that to other forces. We're going to talk, as we always do, about fiscal trajectory and term premium. What do investors want to get paid to own government bonds, especially here in the U.S.? And so that's kept interest rates a little bit elevated. When we look at the equity market, again, the U.S. markets have been a little bit flattish since the announcement of peace, but ultimately, on a cap-weighted basis, we sit at about a 20% premium in valuation on a PE ratio basis compared to 10 years of history. We've talked a lot about how that relates to increased growth in earnings on the big tech-oriented companies. And when we talk about stocks more broadly, they're about evenly valued. So in other words, the PE is about the same as it's been over the last 10 years. That speaks to the potential of a broadening of the market, which we continue to think could happen in the balance of the year. In any event, the other thing that happened is we had Kevin Warsh recently chair his first meeting as chair of the Federal Reserve Open Market Committee. And basically, the key things that happened. First, policy unchanged for the meeting, so a unanimous vote to keep rates where they are. But they did their summary of economic projections, which include the dot plot. That's sort of each individual member's forecast of where they think things are going, including Fed interest rates. And the punchline is there's an expectation of potential hikes here, and the market reacted to that. Now, interestingly, Warsh has talked a lot about not wanting to be overly communicating. The statement was greatly reduced in length. It was much more a statement of facts, a statement of commitment around basically stable prices, and not a lot of signaling of where the Fed thinks policy may be going. And so that was interesting. Another thing that was interesting is that he announced the launch of 5 task forces: Fed communications, balance sheet, data sourcing, productivity and jobs, and inflation, a framework for measuring inflation. And what he said was, hey, we're going to have Fed experts and people from outside that come in, join these task forces, basically get to work on research and draw some conclusions, but try to get that work done by roughly the end of the year. So about half a year to get this work done. I think that's pretty interesting. And what I would say is, he's obviously calling into question how things get done, but it isn't this sort of radical one person trying to drive one agenda. It's like, hey, let's get experts together, study each of these issues, and then I'm going to assume they're going to come up with some recommendations on how to improve things. I watched the press conference after this meeting, and I thought he was very articulate, calm, and measured in terms of where he was guiding things to go. So again, the market reacted, and so, number one, we know inflation has been up a little bit because of this Middle East conflict. But ultimately, between that and then what we saw in those summary of economic projections, the market quickly has priced in 2 hikes in relatively short order. And so that was a move even from before the meeting. Before the meeting, it was bouncing around and sometimes projecting no hikes. And so we're back to this idea of a couple hikes looking forward. In any event, as it relates to our second half outlook, right now, I think the way to think about it is we recognize that geopolitics are here to stay. They're in focus for sure. We're anticipating, if this peace holds, that inflation will cool. We expect the economy to stay resilient, this Fed hike bias to be there, but maybe an easing in that if inflation quickly comes under control. And then I would say rates stable, not lower, but stable, and spreads remaining tight, which is also a signal of the environment being pretty positive. Ultimately, as on the equity side, as I mentioned, there's a potential for further broadening of markets. We'll look at some data in a moment. But we're in an environment, and certainly as it relates to the peace negotiations, to the degree things break down or there's another event, we are in an environment for sure where if something happens like that, we're going to see a market pullback. Now, I always think of it as not so much a fundamentally driven one, right? And unless that event turns the economy in a negative direction, but it's often an emotional event, and then it recovers because fundamentally earnings are strong. Anyway, so that's what I wanted to cover as it relates to sort of what's been going on in our second half outlook. But let's jump into the sections we like to do each month. So first, the economy continued, thankfully, growth sort of roughly at the trend growth line with support from the consumer. The consumer, by retail sales or personal consumption showing a lot of activity and not a lot of stress overall when it comes to things like credit management, things of that nature. The job market has remained close to fully employed, so 4.3% jobs being created, openings healthy. Jobless claims there, but not quite as heavy as what we've seen in prior periods. And so the job market has just remained in a pretty decent spot. That means the Fed ultimately will focus on inflation. Now, one data point on employment I wanted to share, which I think is interesting, is there's been this question about whether artificial intelligence is displacing white-collar jobs or, let's say, jobs for recent graduates. And the data is showing one little signal that may or may not relate to AI. But just to get to the data, when we look at the recent graduates, so ages 22 to 27, so people who have graduated from college, their unemployment rate against the standard unemployment rate, they've tended to be a little bit better off, meaning the lower unemployment rate, until just after the reopening of the pandemic. There's been a reversal of that, subtle as it is, but where recent graduates' unemployment rate is just a little bit above the overall employment rate. So that's an interesting data point, which people are unpacking, may or may not be related to AI, but an interesting thing to see. As it relates to employment and AI, we have talked a lot about the Jevons paradox, the idea that when you see a certain capability become super inexpensive, rather than the jobs related to that going out, the demand for it goes up and the jobs remain. And so, here's another example of that, basically travel agencies. So you think about the idea of the introduction of online travel support, but the reality is because that's all gotten easier to do, et cetera, and people are traveling a lot, essentially travel agencies' employment there, obviously a downturn from the pandemic, but with that recovery kind of back to levels that are pretty reasonable. I mentioned inflation heating up, so CPI and PPI really show a big buildup recently, and that is a data point that is reinforcing this idea of potentially 2 Fed rate hikes in the near term. But, this is something that we're seeing outside the U.S. So the Bank of Japan, for example, and the ECB both have hiked a little bit recently. And so everybody's sort of in this mode of tightening a little bit, again, trying to fight against inflation. So again, we'll see what happens here because those inflation expectations seem to be falling. As it relates to the economy overall, I would just say the forecasts have remained reasonably stable, maybe a little bit of softening, but consensus is right at that 2.1% growth rate, which happens to be trend growth through this century. So anyway, now moving on to fixed income and rates, I mentioned the idea that Treasury rates have remained reasonably stable. That means yields on bonds in various categories are in a decent spot, and for investors, sort of attractive yields looking forward. We've watched credit, and we're not seeing a lot of deterioration in credit, including high yield. Those are below investment grade bonds, being reasonably stable in terms of the default rate, which are always present in below investment grade bonds. I've talked about fiscal trajectory. The punchline here is we really do believe that something has to happen. We keep spending more than we take in, so we have deficit spending. That's a buildup of debt. Investors have to buy that debt. People are going to start demanding higher and higher rates as a result. So something that we will keep in focus. Right now, the forecast is for that debt really to grow based upon that spending pattern. And ultimately, we've talked a lot about it, written a lot about it, and ultimately what we want to see is a little bit more sort of focus from the federal government on this issue. As it relates to how it works around the world, the same kind of thing happens elsewhere. And so that just generally speaking, government bond yields have been climbing. And so that's something to be mindful of. For investors, that's good. It's a forward-looking yield, but that's the cost of debt to the governments, and that can be challenging. Now, as it relates to the performance of the bond market, I think I'd focus on since the piece was announced, for example, basically flattish. So the rates haven't moved a whole lot. And year-to-date, numbers that reflect just a slightly higher level of interest rates. So pricing on bonds gone down just a little bit, but the interest on bonds making up for that. So modestly positive returns is the way to think about it. Now, turning to equities, I mentioned the idea that we're in a resilient environment, so profits remain Healthy earnings remain healthy. Earnings growth forecasts remain very positive, actually. And, ultimately, we've talked before about this idea of the top 10 companies, many of which are these big tech-oriented companies becoming more and more dominant in the index. And so what we're expecting, as I've said, is some broadening potentially in that. This valuation chart is one we just looked at, is kind of reinforcing that view. And ultimately, when we look at performance, for example, year to date, the S&P 500 index, kind of a bellwether index, up 9% year to date. That's a very healthy first half of the year. And then the equal weighted index, so a measure of the broadening, is up just a little bit more. So, and in fact, if we look down to the Bloomberg Magnificent Seven, that those big tech-oriented companies are net year to date are actually down 1.5%. And so we have seen a modest broadening in the first half, and we do expect that potentially to continue looking forward. Now, we've talked a bit about geopolitical shocks going back to 1950 and how the market reacts negatively to that. A lot of times we're early, and then it recovers. And that last line on this this page is showing the current Iran conflict, where we had that negative move after a week and a month, but then over 3 months and then almost 4 months, basically a good recovery in the equity market, net, meaning since the beginning of the conflict, that's a positive return. So markets have gone higher. Now, just to refocus a little bit on our long-term topics, one is AI, the buildup, as we've talked about before, of the models that are out there, their capabilities, and then the build-out of AI capability across all industries, really. And so that just continues. Companies continue to deploy capability. That's going to improve productivity, improve the quality of work, in my opinion. And so all of that is going to be related to sort of efficiencies and productivity, and net will be a positive. We see that happening across all kinds of sectors, and ultimately that we think that's going to be helpful to earnings growth. We talked about the idea that investors are going to continue to focus on how capital gets deployed, whether it's the infrastructure for AI or businesses, and whether a return on that investment is happening. Right now, we're optimistic about it, but that's coming into investor focus for sure. And ultimately, we also know that certain sectors and industries that we've talked about before have been impacted negatively by the risk, the fear that AI will take over some businesses. Now, we've talked about thinking that that's a little bit overdone, but at the same time, when you're investing in a company, you want to understand fully their offering and whether, in fact, AI can take it out. And if it can, it's an investment you probably don't want to make. But ultimately, a lot of this, in our view, has been a little bit overdone. So again, articles on that, links in the notes, the deck that's included in the notes for this session. So I'll close, as I often do, with our long-term themes. All that works into this sort of longer-term strategic view of things like technological innovation and strategic resources and how they're being supported, changes in demographics, changes in consumption, and the idea that competition can be quite productive. So listen, I want to thank you for taking the time to listen to this investment strategy brief, and we'll look forward to seeing you in July. Thanks so much.